is the co-founder and managing partner of Ridgeline, an early-stage venture capital firm committed to enhancing U.S. national security by driving economic resilience across supply chains, manufacturing, defense, and deep tech. Previously, he held key roles at Anduril and Universal Pictures, where he drove business growth and oversaw major M&A deals. A former U.S. Army infantry officer and West Point graduate, Ryan has an MBA from Wharton, might have heard of it, and an MPA from Harvard. Outside of his professional responsibilities, he serves on various corporate and civic-minded boards while enjoying life with his family in Memphis. Thanks for joining us, Ryan. And then we have Paul Madera. So Paul, sorry about that, John. So Paul co-founded Meritech in 1999 and helps lead the firm's consumer enterprise and fintech practices. He's been named to the Forbes Midas list multiple times. For those that do not know, a recognition given to the world's top tech investors. He began his career in finance as an investment banker with Morgan Stanley, and prior to joining Morgan Stanley, he served in the Air Force as an F-4 and F-16 pilot. Paul's an Air Force Academy grad with a Stanford MBA. He currently serves as a trustee of the Stanford GSB and on the board of the U.S. Air Force Foundation. He spends time away from the office cycling across the Bay Area to prepare for his century rides. I've heard from several venture capitalists over the course of the last few days that you are a friend and mentor to many of them, so thank you for all that you do. And then last but not least, thanks, John, for joining us. John Drew joined TCV in 2002, and he currently serves as general partner and senior advisor. He has over 20 years of operational, financial, and technical experience, including leadership positions at several global technology companies. Before joining TCV, John served as one of 4 CEOs at Lucent Technology. John began his business career as a sales consultant for CF Software Corporation after serving as a captain in the United States Army. Recently, John joined with Honor. He joined their advisory board, which, if you don't know that organization, great one to get involved with. It's focusing on strengthening U.S. democracy by supporting principled veteran leadership in Congress. He holds a BS from West Point and an MS in business policy from Columbia University. So welcome, everyone. Help me fill in some of the gaps. So I'd love for maybe Ryan can go first and maybe talk to us a little bit about how you got here, what did I miss, and please give us a little bit of an overview of your fund strategy.
Yeah, so hi, and thanks, Lenore. I'm going to do this as quickly as possible, but it's not that quick. So how I got here really starts with a 25-year friendship. So my co-founder, Ben Walker, and I, we both went to West Point together. We've known each other for a very long time. But it's interesting because we couldn't be more different, right? Like he's from, well, firstly, we're like a salt and pepper combo, if you get what I'm saying. And then, he's from Georgia, I'm from LA. I studied physics, he was an IR guy. But we couldn't be better friends and complement each other even the way we do. Both went infantry, both went to Fort Stewart, if that's what it's still called today, and deployed a bunch to Ramadi and Fallujah together. He went off to special operations and did some consulting stuff, but I eventually got out. Thankfully, my wife was much smarter about the world than I was. I got hurt at one point on one of my deployments, and she's like, look, this isn't going to work. You need to do something else. She told me she's going to go do this Wharton thing. I was like, okay, that sounds good, because we didn't learn about that stuff at the academy, right? You're focused on leading a platoon, not going to business school. But anyways, so took her plan. I'm really good at executing. Did the Wharton thing, touched investment banking, but really cut my teeth and became like a skilled corporate infighter at Comcast, where I eventually ended up leading all the strategy and BD for one of their divisions, which included a lot of corp dev and corporate venture capital. For any of you that have done strategy jobs, there is a frustration that builds over time that you don't actually own anything. And so I left there and went to what at the time was a small company called Anduril. I was an early employee there, led their growth business to get that operational experience and have some ownership. During my time there, Ben and I quickly figured out that there was what we thought was an inefficiency in the market, right? So what Anduril was doing really well was bringing best-in-class technology to a market that was hungry for it. And at the time, this is back 2018, 2019, there weren't as many VCs really doing that. There weren't very many VCs helping that technology company that didn't know that they have a relevant defense product, like navigate that market. And so that's what we started Ridgeline to do. We started Ridgeline to really be that VC that can help, hold your hand and tell you how to approach this market, and most of the time, when not to approach that market. Over time, we've brought on some interesting corporate LPs. FedEx, Cisco, and some other Fortune 500s are strategic LPs of ours. And recently, we were selected for the Office of Strategic Capital's SBIC Critical Technology Program, which is a super interesting program. If anybody wants to know more, I'm happy to talk to you about it. But all this to say, if you were a combat arms branch, we always say, don't fight fair. This is a real advantage in the space, if for no other reason than the returns that you offer your private capital investors. So what you'll hear me talk a lot about is I'm not like a 10-year technologist from Google, and so how we've been able to be successful is really by leveraging our strategic partners, right? Being able to be the ones that connect the dots, and between FedEx, Cisco, DoD, like we're going to have those partners that are going to help make us successful. So that is a much longer answer.
Perfect.
Okay.
Thank you so much, and congrats on the SBIC designation. Like that is a big deal. I'm looking forward to that supercharging your next fund.
My hair was jet black when we started that process.
Maybe John, if you can go next, just fill in some of the gaps and talk to us a little bit about your fund strategy.
Okay. So I was in the Army, got out in '84. My last assignment, I came back from Korea and was assigned to advise the National Guard and Reserve units in the 5 boroughs of New York City. So I worked on Tuesday nights, Thursday nights, weekends. So I took the opportunity to go to business school at Columbia, and that really helped me transition from the military to civilian life, because at the point I did not know the difference between sales and marketing, and anyway, just picking up the jargon, listening to other people. It was an executive degree program, so they were all business owners or VPs or presidents of different companies. And so anyway, I sold software out of my apartment during that time period to help pay for school. And one of the guys I went to school with said you ought to apply to our company. And I went into sales at Sperry. If you remember that, you'd better have some white hair. But anyway, that's back when the computer chips were made out of wood. So it was a long time ago. But anyway, I went through sales management, and he rotated me through finance and marketing, general management. And I ran a little business. It was right when internetworking was beginning in '89, and a little business that grew rapidly from 6 million to 250 in 3 years, and got recruited to Silicon Valley in '94 to run a network consulting and software company, a company called INS. And so in '95, we were named fastest growing company in Silicon Valley. '96, we went public. In '99, November, we sold to Lucent for $3.7 billion, which at the time was a lot of money. And I think it was one of the top 10 acquisitions, tech acquisitions, for about a week. And then a lot of other ones happened after that. And so after, I ran Lucent into the ground for about 14 months, and then as one of the 4 CEOs there, and then thought I was going to retire. And after 6 months, my wife told me otherwise. And so I went back to work, and I was going to go do another CEO gig. And as I was talking to all these VCs about their companies, I became more interested in what they did. And so I got a blind call from a headhunter. TCV was looking for somebody with operations background to be a general partner. So we took a chance on each other, and 23 years later, still chipping away at it. I'm winding down that stuff and winding up the do-gooder stuff, a lot of veteran support organization stuff. And so that's how I got here.
No, thank you, and I appreciate more on that path into VC. That's usually people's first question, how did you get into this? Paul, where's yours?
So I've been doing venture investing in tech for 25 years. And when I got started, there were all of about 12 of us across Silicon Valley that were veterans involved in the tech industry, and John was one of them. And so this is just fantastic to come here and see this room filled with veterans interested in the tech industry. Thank you, Tim Shaw, for getting us together and for doing this for several years now. Tim does this because he loves our community, and it is the greatest thing that we could have going for us. Really sincerely appreciate it.
Okay, quick round of applause. No one does more for this ecosystem than Tim.
So my own by the way, thank you, JP Morgan, for helping sponsor this and making it happen. We veterans don't have deep pockets, at least when we're startups and new fundraisers, and so your help really makes a difference in getting us together. So my own background, not as interesting perhaps. I grew up in a Navy family, which meant we lived in Hawaii, we lived in Southern California, and on the East Coast.
Rough.
I figured out early on if I wanted to get into jet fighters, which I did after watching the Marine F-4s at Kaneohe Marine Base fly overhead where we lived in Hawaii. I figured out the best way to get into those was to go to the Air Force and the Air Force Academy. So I went there, did get into fly F-4s and then F-16s, and then spent a little time figuring out I would apply one night to business school. So I wrote applications for 3 business schools. I figured if I got in, I would go, and if I didn't get into any of those 3, I would stay. One of them let me in, so I headed off to California, went to business school, spent some time in Wall Street for a few years after that, and then we started Meritech Capital in '99. Do you want us to talk about what our funds do, or?
Please do. That would be
Okay.
wonderful.
So Meritech Capital has only done one thing since we got started back in '99, and that is do late-stage tech investing. And that means companies that are kind of 10 million plus in revenue rate still have a lot of risk to them. They still have to expand. Hopefully they go public in 4 to 5 years. We're currently investing out of a $1 billion plus fund. We write checks of between 20 and 50 into companies. And I love nothing better than seeing veteran companies or veteran execs at tech companies that we can talk to and see if we're a good fit for.
Are there any particular themes you're really interested in right now?
Yes. Subscription software, which is the theme of most tech these days, tech venture, that's about 2/3 of what we do. And then we do 1/3 of everything else. So it can be literally anything, a lot of cyber, a lot of even less interesting tech, but still fast-growing tech. My latest company is a company called eGym that's out of Munich, and it is a company that makes very high-end gym equipment that has tech features to it, and they offer a corporate benefit that they structure. It's growing fantastically.
All right, I like it. Let's see. Ryan, same question for you. What are the themes you're interested in right now? Maybe a little bit more specifics on who you invest in.
Like the type of founder? Oh, yeah, that's a different question.
Check
probably.
sizes,
There it
themes.
is. So we are incredibly smaller than $1 billion. This fund's going to be 150. We've closed most of it already. Our last fund was 50 million. So we're seed Series A investors. We like to invest a lot in AI and digital infrastructure, kind of like everybody else. A lot of supply chain, and I like a lot of hard tech and deep tech. Things I'm really interested in now. I like a lot of circular economy stuff, sensors, and IoT. I know that sounds like kind of an old one, but I think it's going to be even more relevant as we get into this AI and agentic kind of phase here. And energy abundance is a big one for us too. So we look a lot at like biofuels, SAF. But I mean, frankly, part of this job is, in my opinion, is being willing to to hear things that you didn't know about. So I'm sure there's plenty of things that I just haven't thought about that would be interesting for us. So please don't think that list is exhaustive.
Oh, perfect. Same question for you. What themes are you really interested in right now?
Right. So TCV has historically been a late-stage venture firm, and so as we've grown, our funds have gotten bigger. And typically, any fund is going to have about 20 to 25 investments in it. So depending upon how big your fund is, divided by that, and that's how big the average check size is going to be. So right now, our checks are 100 to 300 million for a new investment. And oftentimes, we used to be called Technology Crossover Ventures. And then when you become an acronym, you've really made it. So we're TCV now. And so the model that we've used historically is to, once we invest, we try to invest more over time. So at an IPO, when some early stage venture firms have been in there for a while and it's time for them to leave, and they look for opportunities to liquidate, we're buying more. So almost all of our companies that go public, we buy more at the public offering. And then if they have the momentum that we're looking for, we buy more again. An example would be Redback Networks. We bought, they were having trouble. We came in and put $30 million in an hour after they got out of Chapter 11 because they had a product line that was actually growing while they were going through Chapter 11. And it's sort of like, who is going to buy anything from a company that's filed for bankruptcy? And a lot of companies were. And so we believed in that. We believed in the Kevin DiNuccio, the CEO. And then we invested $52 million in the open market because Kevin would miss a quarter about every 3 quarters. So when the stock dipped, we went in. And so we got a 5X on the 30 million, 52% IRR on the open market purchases. So our model works. And so that TCV crossover thing is part of our basic model. We're solely focused in on information technology investments. So we're not into a lot of the other interesting areas that other people are into. We've looked at crypto a lot, but haven't really gotten the guts, I guess, to go into that yet. And we're just beginning to look at military tech companies because of the huge change that's happening in that sector right now, where obviously a lot of smaller startup companies are challenging the big defense contractors that have been dominant for so many years. So anyway, that's where we are.
And I do want the audience to start getting your questions ready. We're going to turn it over to you here in about 3 or 4 questions. So we'd love to keep this conversational and make sure you get answered what you want to get answered from this. What do we got? 80 years of venture capital experience on the stage right now, give or take. Ryan, over to you on this one. What do you look for in the entrepreneurs you're investing in?
Yeah, so we have learned over time that the stage we invest at, it's so early, it's hard really to get there's not a lot of edge to get your hands around. And so what we look for is like an authenticity to the founders and the problem they're solving. So we really like founders that are solving a problem that they've struggled with, that they know, that they've hated, that this is it. Like, this is it, I'm done, I had to solve this problem. That's why I built this company. That's exciting for us. We also like the founders that feel they know something that the market doesn't, right? Like that inefficiency, that they have like a secret. That's what my partner Ben always likes to say. But all that to say, we really do sort of bias towards founder-led companies, and I think in a lot of ways, what we've found is those founder-led companies, more so than any other, are willing to do whatever it takes. Like whatever it takes to, like you heard the founders up here a second ago, to raise money, whatever, like you're running out of money, I'm going to close these people, whatever it takes. There is a different vibe we found with other types of companies, but yeah, that's what we're looking for.
And how early do you want to meet entrepreneurs? I mean, is it plan on a page? Like, do you have to have a product? Yeah. How early do you want to meet folks?
As early as possible. So an idea. I might not invest at said idea, but if you have an idea, I can start thinking on my end, is this something I'm interested in, and is this something I can add value to? So we don't invest unless we feel like we can add value, and we try to add value with those strategic partners I mentioned, right? And so the earlier I know about what you're building, the earlier I can start, dredging up my network to say, oh, this person can probably be helpful, this person. And so now, if I were to make an investment down the road, I have asymmetric information. I could say, hey, I know you're valued at this price, but I know I can drive, X value into this company. And so the sooner I can start those wheels turning, the better. I don't want to say my best, but one of my best companies right now met when he didn't have an idea. He's just a sharp guy at Anduril. And now I'm on his board, and he's raised ungodly amounts of money. So as early as possible. Don't let the stage, don't let the stage of the investor spook you. I think as long as you go in with your eyes open, it's like, oh, I'm just wanting to get to know you. I think most investors would be open to that.
You comfortable sharing the name there or no? Best performing?
company?
Yes.
Oh, maybe not the best performer. Yeah, it's probably the best. It's a company called Harbinger. He's probably raised like 250 million. It's a medium-duty EV space, which is fraught with, a lot of companies in its wake. But this guy, he is the kind of founder you want to back. He is an expert in his space. He kind of misses social cues to where if you tell him no, he doesn't really get it, and he'll just keep going, right? And he will do whatever it takes. And I was able to see that a lot at Anduril, which is great, because a lot of the things that you might worry about is like, does this person know how to scale a product, this, that, and the other? That diligence is done. So, I got lucky there.
Paul, over to you. How do you define success for the companies that you're investing in?
Really a good question. You had me thinking about this. For us, of course, financially, we want to see a 3x return or better. And so there has to be sort of a price and so forth that works. But I think what we're, at this stage of life for me, John sort of alluded to it, we get to look at companies that we really want to be involved with, that we can help, where we think there's a good connection between us, where we have some value to add, where we can help companies get beyond just thinking about us as money. And for me, if it can fit the financial profile, but it also has a great personal fit where I can introduce them to others who are experts in the space, help them build out their management team, help them think about the next phase of growth, who to talk to, which banks to go to, which ones not to go to. Always go to JP Morgan, by the way.
Yes.
That's the most rewarding deal I was ever part of was a company called Dealer Socket. It's a company none of you have ever heard of. But back in 2006, I met Dealer Socket. They didn't have any investors. They had bootstrapped themselves to a 6 million run rate. And it was 4 BYU grads who had taken on the concept of building software for the auto industry. And at the time, the auto industry didn't really have much software, still doesn't, by the way. But anyway, these dealerships could use software to optimize their marketing. And there were 10 competitors, all offering very similar stuff. But these 4 just had a magic to them. I ended up being their only investor. They ended up growing the company and dominating that field and finally selling themselves to Vista Equity.
Yeah.
And it was a great outcome for that team and all their employees, and it was just a wonderful experience. I would love to repeat that again.
What was their special sauce? I have a bias. I'm living in Utah right now, and I happen to think BYU's got some of the best sales folks out there.
Oh, they do. And that used to be our secret, but everybody kind of knows that now. The greatest salespeople come from BYU. They all went off on their mission overseas. They learned to speak foreign languages. And they sold religion for a couple of years, and software is a lot easier than that.
Fact.
And in fact, I look for that quality at companies we look at now.
Oh yeah, persistence, right? And grit, for sure. John, back over to you. What does it take for companies to win in this environment?
It's different for each company, depending upon how they're positioned. Generally speaking, it takes a lot of grit. As you were saying, those people who will do whatever it takes to get the job done. I think you really have to be able to do one thing better than anybody else. And a lot of companies get distracted by trying to expand into new product categories too soon, or maybe go after international expansion before they've really tapped the U.S. market. And so, that I think is one of the things that somebody told me in a board meeting when we were looking at expanding into software. I was running a consulting company, and Larry Flint, who you might remember, he said, great companies do one thing better than anybody else, and I've always thought that was the case. And so, but in this particular environment, it's really difficult to be good at projecting sales because things are really choppy right now. Companies, especially if you're selling to large enterprises, companies don't really know themselves how well their company's going to do, so they hold back on making large commitments. And so sales superiority is a key to anybody being successful in this kind of environment.
Concur. All right, so next one. Look, for you, Ryan, is you get a lot of entrepreneurs, especially I think in your space, in the room. What is the best way for them to approach you or your firm?
Yeah. It's so interesting listening to the founders up here a minute ago. Because Lenore gave us these questions ahead of time, and what I thought to myself is like, I'm going to say, don't cold outreach me, because that's not going to work. But I guess to answer your question, a warm intro is always best, right? Like the way I think about life is I try to create as many filters as possible, or to have gone through as many filters as possible. So by the time I go to somebody with something, they're like, oh, got it. You went to this business school, this thing is whatever. You're at least smart enough for me to start talking to you. If you can find a filter to get through, to get to me, that's fantastic. Like if one of my founders could introduce you, that's great. But beyond all that, like these other founders up here a minute ago were saying, try to do your homework. I don't think it does anybody any good if you're like, oh, I make bespoke lotion, and it's like, well, I don't really invest in that. I'm happy to be helpful to try to find you an investor that does, but to the extent that you can show up informed, I think that's probably the best way to show up. Yeah.
John or Paul, do you have anything you want to add there?
Sure. I love to talk to everybody, so please email me at jdrew@tcv.com. Send me all your plans. I'm sorry. I kind of say that, of course I'm joking, because all of us get about dozens of emails every day from all kinds of reach outs from companies. Most are not very interesting, some are, but the reality is that I get a lot. I am only a later stage investor. I get scads from all the seed and pre-seed ideas out there that there clearly isn't a fit, and so they're kind of wasting their time chasing us down. So if I can recommend a couple of things to you. One is, do not go out and buy one huge list of investor names and email all of them. It is much less likely to be effective. I do have a couple of ideas. One is, if you're going to do warm intros are always the best, but if you do cold reach outs, try and look at the firms that invested in your sector and in your space in the past, and try to find the partner that invested in that space. And particularly if it was a successful deal, they're an expert in it, they'll be more receptive to a cold reach out if you send it out. And of course, watch the stage difference.
I like it. All right, John, over to you. what is your secret sauce? What makes you a good investor?
I think it's, I wouldn't call myself a good investor. I would call myself a good partner for a CEO. And so once I get involved, it's roll up the sleeves, dig in, and figure out what are the next hurdles we got to get over to achieve the next milestone we're after. And so I would say that I've probably missed deals because, I wanted terms and things like that that somebody else didn't want. All that is really a bunch of bunk until you get involved with a company and you start working on their problems together. And so I'd say that I'm a good partner for a CEO. Secret sauce, number one, I want to be the chair of the compensation committee. And so I want to be involved with every single key hire. I want to, be there to help attract and retain that type of talent. And then that really makes me part of the day-to-day operation of what's going on with the company. The other thing is I want to be the first call that the CEO makes if he's got an issue, whether it's a personnel issue, whether it's a customer issue, an investor issue. I want to be that I want to earn that trust to be that. And then after that, it's sort of, you're all in it together, and, hopefully you're involved with the right people and good things happen.
I've definitely learned that when deals get competitive, it's absolutely the firm reputation, the reputation of the partner that really can make all the difference, right? So if you're willing to do that, entrepreneurs talk. So that's, I appreciate that. Ryan, what about you? What makes you a good investor?
This is going to sound like a repeat. I'm not exactly sure I'm a good investor yet. I've been at this 5 years, so.
Early stage, 10-year time horizons. It's hard.
Yeah. I guess if there are any LPs in the room, I'm a great investor. But for everybody else, I don't know. But we do pride ourselves on being very hands-on as well. Like I said, we have all these strategic partners, and the only way you can really take advantage of them is you got to be in the business with the founders. Like my best founder that we're talking about, Harbinger, he calls me on the way to work and on the way back from work every day. And there is a 2-hour time difference, and I'm on the losing end of that time difference. But I am there. I am there for whatever questions he has. I do feel like a partner to him, somebody that he can trust that's not just an investor. And so I think that's where we're probably most helpful and make us a good investor. Yeah.
Paul?
John did say it pretty well. And I have the same philosophy, and that is that being a startup founder is so incredibly hard. Having watched many companies over the years, it is truly the loneliest place on the planet, I think. You've not only got to always talk to your investors like everything is going well, it's positive, it's tell the right story. You've got to talk to prospective investors in the same way, and then you have to turn around internally and tell all your employees how well everything's going to keep morale up and talk about the optimistic side. Meanwhile, you're swallowing all of the challenges that every startup leader has to deal with, and there are so many of them. Everything from having to fire people, as you heard from that last panel, figuring out what the next product's going to be, figure out where you're going to get the next round of financing. All of those things founders take upon themselves in large part and don't even share necessarily with their close co-founders. So if we can be the trusted partner that you can unload to, that's where it really gets fun, interesting, and we get a lot of return from that as well.
Thank you. And we have some startup founders lining up to ask questions. So Emery, this is over to you. Confido Legal.
Awesome. I'm Emery Wager, founder of Confido Legal. Paul, we got to chat a few months ago and grateful, learned a ton from that conversation. The question for the panel, oftentimes in the military, we're taught to kind of put our head down, do whatever it takes, get it done, and be kind of a quiet professional. But then when it comes to fundraising, especially, you kind of need to be able to tell that 100x story. And sometimes I think those character traits can come into conflict. What's your advice? Like, what are you looking for? And what's your advice for a founder that's coming from that military background that maybe needs to be a little bit more, charismatic in telling that story?
Who wants to take that first?
I have an opinion. So I am with you. I actually struggle with this quite a bit. And on top of that, I'm an introvert, right? So that's like double death, right? So what I would say is what got me over this, because I actually don't even do things like this. I only show up for this because of Tim Shaw, right? Otherwise, I don't do even this. What got me over that was being more excited about what I was offering the other person, right? Like, it's not like I'm trying to trick you. It's like, this is a great thing that I want you to be a part of. And I think that really helped me think of it less like transactionally, right? And like, oh, I'm the greatest thing ever, you should want to join. It's like, this is a great journey we're going to go on together. I want to bring you as part of it. So that's how I framed it, and it helped me a lot. These folks have been at it longer.
I have a couple ideas. One is that we military types are terrible interviewers. We really are. I mean, it has been pounded into us that we're a part of a team, and the team succeeds. We're not individual success types. We're not stars. We only work as a group. And that's why when you go in for a job interview and you talk about how you worked really well with your teammates and you all achieved a few nice things, you sound like mush to whoever you're interviewing. And that's part of the problem as an entrepreneur when you're telling your story to investors. You should know, we are used to hearing investors come in and tell us the craziest optimistic story. We expect it. We want you to have that view. Successful entrepreneurs, we have all learned, are a little bit crazy. And they're crazy in the sense, not the Adam Newman crazy, by the way, but crazy in the sense that they just don't see obstacles. They are determined to win. They are going to make their company the largest in their particular space. And we actually want to hear that kind of story. That is positive. That is a benefit. Even if it is unlikely, it is absolutely an essential element.
I guess the only thing I would add is, being in the military, we get a lot of leadership training. And oftentimes we're put in front of groups of people that we need to motivate and direct. And, being able to channel that kind of training that we've all had into, a discussion about whatever you have passion for at this very moment, I think works. And just like in the military, where we practice things over and over and over, go have those conversations over and over and over, and you see how people respond to different parts of your story. And from that, you create your own cadence for, how you conduct your presentation, how you conduct your meeting to get the impact that you're looking for. So I think we've got an advantage because of the background that we've been given.
Awesome. Thank you all.
Good morning. My name's Bob Louthen with Veteran Crowd. Ryan, years ago, I was in an SBIC, great program. We had what we called a balanced portfolio at that time. We had 3 IPOs and 3 bankruptcies. And so John Kennedy said, I think, that success has 1,000 fathers, but failure is an orphan. I'm curious the lessons that you guys learned from the deals that didn't go well.
Give you a second to think on that.
None of us had any deals that didn't go well. That's a really good question, and it is absolutely something that smart investors, all investors, reflect on a lot. I can tell you, I've had a couple of things that I noticed after investing, and they sort of correlate with lack of success. One of them was, and I didn't catch this early on, I remember going to meetings with this management team several times as we were evaluating an investment. And every time we would ask questions of the team, the CEO would do all the talking, all the answering, and everyone else sat there with their mouth shut. And it wasn't until after we invested and realized that there was terrible team dynamics in that company and that led to failure that it really became clear that that is something I needed to watch for in the future. Today, I watch for that in every single meeting.
I don't know where we went off to, but for me, it's a little more squishy. If it doesn't feel like a good fit, I'm not going to do this deal anymore, right? It could be great tech, the company could be fantastic, but I don't have any failures yet. But one deal I just do not want to work on. I do not want to interact with this team. It's just because in the beginning I knew this person and I aren't a fit. Like, we're just too different, right? It's not going to work. It doesn't scale for me. And so early stage, because we're so hands-on, that creates difficulty, right? So I think for me, it's the lesson learned is spend a lot more time with people, like on the upfront, like in person, do lunches, do something social, just see if you can stand this individual. Sorry, stand is the wrong word, but you get what I'm saying.
Right. I would say, when we're looking at an opportunity, we look at market, management, and momentum of the business. And so when things fail, it's typically one of two things. It's either management, I got that wrong, they aren't as good as I thought they were, or it's market, management, and I got it wrong. And, sometimes, companies, for all the effort we put into it, they just don't work out. And you're lucky to get out with your, return of your money instead of return on your money. And so, but those are typically the two areas that, have caused what would be called a failure for our investments.
Before we go to the next question, this one is more my personal curiosity. What has been your biggest miss? What is the email pitch that came in and now's the unicorn, and you look back and like, can't believe I didn't pick up on that? Everyone's got one.
I have a long list of them. One of the biggest is Netflix, which John and his partners did not miss. And in fact, they rode that several times up and down. I mean, it's really a phenomenal story. We missed it. At the time, it was actually just DVDs by mail. And very early on, and they didn't have enough data to show that there was enough renewals at the end of the year subscriptions. So we sort of passed on it and thought, probably isn't going to go anywhere.
I don't know that we had any better insight, but Reed Hastings was somebody we had invested in before. He had a company called Pure Software. And so we generally have a rule: if somebody makes this money, whatever they do next, we want to be a part of it. And so he just happened to get pissed off about Blockbuster charging them late fees and did something about it. And so we were involved with that. And we invested in TCV2, TCV4, TCV6, TCV7, TCV8, and TCV9. So we kept investing.
This is one of the greatest stories of the last 20 years.
Yeah,
They just popped another 15% like just the other day. It's congratulations.
crazy, yeah.
John should be buying us lunch, by the way.
Yes,
No.
yes.
We're fully distributed, so we didn't take that ride.
I also missed HubSpot and Peloton and many.
Peloton, given your enthusiasm about exercise equipment, that one must have been a little painful. Oh.
This is kind of a non-answer, but Joby and Shield. Joby, we just didn't have money. Like, we tried to raise this SPV, we couldn't get there. And Shield, we had money, but it was like, if we did that deal, we'd become more of a defense investor, and that's not where we were. But those two companies have crushed ever since, so it's still hard to look at.
Yeah, I'd say the big miss that I personally had was LinkedIn.
Wow.
At the time, we're competing for a later stage round, and there's something. I mentioned terms before. Valuation is important for an investor, obviously, and then terms. And so one of the terms that I was going for was an IPO ratchet, meaning that if you go public at a price lower than what I invested at, you got to make me whole. And so anyway, at the time, the valuation was $1.2 billion that they wanted, and there were only 5 tech companies that had ever gone public for $1 billion or more at the time. and it looked like a job board. So it's sort of, I got to have that ratchet, and that was really stupid because the other investor dropped that requirement and got the deal.
Thanks for sharing that. Go ahead.
Hey there, my name is Benjamin Bunn. I'm the Deputy Executive Director for Warrior Rising. We specialize in helping veteran entrepreneurs essentially receive coaching, mentorship, but more importantly, just educational opportunities for starting their own business, both big and small. Couple things. Paul, you mentioned BYU graduates are good at asking for money. My executive director is a BYU graduate. I'm here to tell you.
Jason Van Camp.
Yeah,
it's
that
amazing.
dude. Yeah, he will ask you for money aggressively.
Right after this.
Yeah, he's actually standing outside. But also, Ryan mentioned that the cold outreach doesn't work. I also have successfully founded and fundraised a couple CPG companies. For the venture guys in here that just heard me say CPG, I know what you're thinking. Gross. Like a lot of VC firms are not into investing in CPG, but if you've ever walked into Walgreens, I'm here to tell you it still exists. People are still buying toothpaste. But anytime I've ever received capital investment, it has always been from a warm introduction from another founder to that investor. And that's like a really, really great piece of advice. And I just hope for the people in here that are looking for capital access, please don't overlook that. If you have friends that are founders and they've received investment, they're your best resource. They're the clear blue line to actual capital investments from VC or otherwise. And you also said that having a good partner and somebody that's an investor is something that's a strong suit of yours. I have taken investment capital from individuals that were not familiar with the category that I was working in. And every conversation, I just got wire brushed because we didn't understand one another. So having somebody that can act as an actual partner is so important. I just wanted to say, like, hey, thank you for sharing that. Those were like great pieces of insight. And for the people in here that are looking for venture capital or otherwise, I hope you were paying attention. My question is, I have probably about 150 individuals that sign up for our programs per week. We've helped more than 13,000 individuals who have come through our programs on a regular basis, and less than 0.1% of the individuals that come through our programs are actually in a place where they can receive venture capital. Less than 1% of all startups will ever receive venture capital. Who's a founder in this room? Just show of hands, like you're a founder. It's like the statistics for whether or not you're going to walk away from this with capital, a capital investment, are very jarring, right? And so it's like, hey, listen, if I can't actively fish, then I should be back at shore mending my nets. So when you're talking to initial, individuals, founders who are looking for a capital investment, and that they're not ready yet, what's the biggest pieces of advice, or where are the areas of improvement that you see the majority of those founders need to look back and start fixing before they're able to come back and hopefully get involved in substantive deal flow? And my sense is those problems probably vary by degree, not type.
So I think almost all of us on the panel would say, though, that venture capital isn't right for everybody, right? And if you can bootstrap, if you can do without it, like, by all means, build a company, keep your equity, build your own self-worth. I think most of us would align on that. But who's got some advice here?
I'll start. Most of the time, like, it's something like an actual problem, right? Like, there's tech risk. We like to see a product or something first, right? Or your revenue, or you haven't figured out product market fit. And so there are those easy ones that are discrete that you can kind of say, please fix this and come back, right? Like, assuming your technology is in a space that that works for us. And then there are the folks that need to go back and probably get better at how to raise capital, right? It's one thing to say, like, oh, this company's great, but you have to be able to raise money. Sorry, this might be like a circular kind of argument here, but it's like, if I don't know how to give that feedback to a founder. Sometimes it's like, this pitch just isn't working. Everything else, you have all the pieces, but to invest behind you doesn't feel like you're going to be able to convince the next investor to also get behind you. I hope I gave you guys enough time to think of a better answer.
So one of the things is that while companies are competing to get investment capital, we're competing to get those companies. And so our firm goes and meets at the company with 1,250 companies a year, and we invest in 8 of them. And so we're typically investing in a company 4 years after we've had our first meeting. And so we've had that time to hopefully add value to that company so that when they decide they're going to raise capital, we get a call, hopefully the first call. But secondly, did they do what they said they were going to do? And so we're constantly tracking those companies, what they thought they were going to be able to do, whether they actually did. And so a lot of it has to do with, if you're going to go project something, if you're going to go, talk about a proof point that you're going to achieve, do it. And then you'll get people like, us that are going to want to be part of that next milestone that you're looking to achieve.
I just had one comment, and that is that most of us don't want to give you really accurate feedback. It's hard, it's uncomfortable, and you may not want to hear it. But I would encourage you, if you do get the turn down, reach back out then or maybe a week or 2 later and just say, hey, I would really love to get some accurate, helpful feedback. And you can say anything to me. Tell me whatever you really think. And that way you may get something that's more worthwhile. Otherwise, you're just going to hear, wasn't a good fit, we might have a conflict, we just, current fund is running low on funds right now. You'll hear all kinds of things, and none of them will be very helpful to you.
Thanks for your insights, gentlemen.
Thank you. So I've got 2 more questions. If you were starting a company today, what would you focus on?
I have an idea here, and that is that, as I said, we do a lot of subscription software, and that may be sort of adjacent to what most of us are working on here. But if I was starting a company, what I have seen certainly over the last 20 years being immersed in the SaaS world is that, we started out with several major sector dominant providers. We had SAP offering accounting software. Salesforce showed up and they did sales management software. Marketo did marketing software. And what's happened over the last 20 years is those major sectors have been carved up into increasingly smaller niches, specialized areas that turn out to be quite big. And so we see companies that are taking just a part of the sales process flow and doing it better than Salesforce and marketing their product. And it turns out to have a very large TAM, and with the right background and experience, they can produce something of tremendous value. So I would, and I think, by the way, I think we're in the early stages of this. We are going to see all those major software sectors continue to expand and specialize, and we're going to see AI product layered in on top of workflows that will make it better and more valuable, and I think there's tremendous opportunity there.
John, Ryan?
I'm probably the wrong guy to answer the question because I really, other than the not-for-profit organizations, I've never really started a company. When I joined INS, we had 56 employees. I wouldn't call that a startup. And so I do think it goes back to everybody, like Reed Hastings. He got pissed off about paying late fees. If you have a problem that you think you can solve, and you do it, you focus in on that, and it seems like it could be a big enough problem that affects enough companies or enough people, then you're onto something. But beyond that, I've never done it myself, so.
Find the pain points. Okay.
Yeah.
Ryan?
I would start a biofuels company. I know it's like an oddly very specific thing, but I live in Memphis now. I just moved there from 2 years ago. I still count that as just. So you start to look around at what is going on and around you, and I noticed in that region they have a lot of access to what they call feedstock, right, like soybeans and things like that, and there is a dearth of sustainable aviation fuel, biodiesel, all that good stuff out there, and so. To me, there's and there's an opportunity in the market, right? There's a mismatch. There's a lot of demand and not enough supply, and so biofuels, sorry.
Do you invest in those kind of companies?
Do I invest in those companies?
Biofuels, would you invest in a biofuels company?
Absolutely,
Awesome.
yeah.
All right, someone in this room is about to win. So,
Absolutely.
what other, last question, just parting advice for our startup founders in the room, any direction you want to take it.
A little bit of personal advice, maybe. Please don't take too much money from friends and family when you're doing a startup. And I say that only because the odds are against you. And they may not be against you personally, but they are against the sector, the broader category. And you don't want to be responsible for taking mom's retirement and not being able to show a good return for it. So I throw that idea out. Go find your friends or J. Drew at tcv.com and get them to write you a check.
All right, I'll take the other side of that. I would not get VCs involved until you need to. And so you can, retain more ownership the longer you bootstrap your company, and there is a right time to bring in a VC, but, don't do it too soon. And so, I agree. I've been in situations where founders have really kind of wiped out a lot of wealth from their sisters, their parents, a lot of people. So it's a really risky proposition, and they really feel bad about that. But that stuff kind of happens with startups. It's hard to be successful. So kind of a balanced approach, but try to hold out as long as you can, and then get the VCs involved later.
Concur?
Just to triple down, if you take VC, know what you're getting into. I would also say, if at all possible, have a partner or a co-founder. And if you can't have a co-founder, find another founder in the ecosystem, somebody you can commiserate with, right? I think you're going to have great partners in your investors, don't get me wrong, and I think your incentives will be very similar, but they won't always be the same. And so you should just have like a safe space to sort of have conversations. And the last thing I'd say is people want to help you, right? Like being veterans, people really want to help you. You got to meet them partway. You got to, when I was getting out back in 2010, helping vets was all the rage, right? But where
That's
a
when
lot
we
of
got Veterans on Wall Street going.
Yeah.
I wouldn't say it was all the rage. We were trying to make it the rage, though.
it felt like it. I mean, I never got into those programs, but what you would find is people would be willing to have the conversation, but you're not really owed anything, right? So if you get that conversation, show up prepared. Like nobody's going to do it for you, but people want to help. So that's the advice.
Perfect. All right. Well, look, thank you for being here. Thank you for all you've done for our community. Ryan, John, Paul, this has been exceptional. And on behalf of everyone, thank you.